It is 9:01 a.m. Pacific Daylight Time. It is the 11th day of May 2026. This is episode 1318 of Bitcoin, and we're going to be talking a lot about the banking industry this morning because there's a lot of banking news that's going on. We are going to talk about this Australia business with a capital gains tax being installed. Then in the second part of the show, I want to address something about Bitcoin whales moving Bitcoin every time the price spikes, because it's making me wonder. It's making me ask questions as to the true motivations of these moves. And then we're going to end up talking a little bit about these Bitcoin ETFs, what their performance has kind of looked like over the past few weeks, and see if we can glean any information. But first, I want to say a belated Happy Mother's Day to all the mothers that are out there. If I have any women at all that listen to this show, if you are a woman that listens to this show, let me know, because the only people that ever boost my show are dudes. I'd like to get some of that women money coming in. You know, some of that female based satoshis, because this show pretty much operates off of your goodwill. And if I've brought you any kind of value or bring you any kind of value today, it would be nice for you to show it in kind by donating to the show. Best way you can do that is Podcasting 2.0 apps. My favorite one is Fountain app. I love Fountain app. You can boost the show with satoshis. You can send me a message at the same time, or you can just set it to stream sats to me. I think the minimum is 10 sats per minute, but of course I'm not going to yell if anybody out there wants to send me 100 sats per minute either. I've had that done, and it's really nice. You want to talk about topping up some Lightning wallets? Wow, that actually has a tendency to do it. You know, and honestly, when you think about it from terms of sats, sometimes letting go of even 7 sats seems like a lot of cash. But when you correlate it back to the US dollar, you realize, wow, that's like way, 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 way under 1 penny. And I'm just hoping that I'm bringing you more than 1 penny's worth of value to the show. So please consider streaming satoshis or giving me some boostograms on any of the Podcasting 2.0 apps, because they're all pretty much connected to Bitcoin at this point. If not, I can always use a 5-star review on Apple and Spotify podcasts. But let's get to the banking issue. First, banking industry says Clarity Act stablecoin proposal would enable evasion. Yes, and when we say the banking industry, what we're really talking about here is the banking lobby in Washington, D.C. that represents the banks, which in turn is, in fact, the banking industry. But really what's going on here is the mouthpiece in Washington, D.C. for the banking industry is now just trying to scare the living piss out of the Congress by saying, we're going to evade taxes. So from Decrypt's Sandra Lutz, we've got this one. A coalition of the nation's top banking trade groups representing Wall Street giants and community banks alike issued a statement on Friday expressing concern that new language in a major crypto bill would benefit digital asset companies and disrupt the traditional banking industry. Let's pause. This is the exact argument that they've been making forever. Well, not forever, but for like at least a year, about a year and a half. They've been talking about that they're scared that digital asset and digital asset companies are going to disrupt the banking industry. For months, the banking industry and the crypto lobby have battled over key language in the Clarity Act, a bill that would formally legalize most crypto activity in the United States. Banks want to add language to the legislation banning crypto companies from offering yield on stablecoins, cryptocurrencies pegged to the value of the US dollar. The banks say that such programs could make traditional low yield savings accounts less attractive. Crypto companies, including Coinbase, have argued that they should be able to compete with traditional finance. For nearly 4 months, the skirmish over stablecoin yield has kept the Clarity Act from advancing in the Senate. Last week, 2 key lawmakers on the Senate Banking Committee finally revealed a proposed compromise on the issue, which crypto leaders quickly embraced. Senators soon after signaled optimism that the problem was dealt with and that a committee vote on the Clarity Act was near. But now a united front of top banking trade groups is asking for further changes to the proposed language, arguing the current draft contains loopholes that would allow crypto companies to evade the intended prohibitions on stablecoin yield. So we're right back where we started from. The compromise language, drafted by Senators Thom Tillis and Angela Alsobrooks, would prohibit the payment of rewards on stablecoins in a manner that is, quote, economically or functionally equivalent to the payment of interest or yield on an interest-bearing bank deposit, end quote. But it would also potentially greenlight rewards tied to participation in governance, validation, and staking, and rewards calculated by referencing a user's account balance. Today, no less than 6 banking trade groups representing all major national banks and community banks in every one of the 50 states wrote a letter to the Senate Banking Committee arguing that those exceptions are overbroad. Quote, "We're concerned that the proposed language includes exceptions that will enable evasion of the intended prohibition and incentivize customers to hold and grow stablecoin balances at the expense of deposits." Okay, so I was wrong. This isn't about evading taxes. It's about evading the prohibition. Okay, well, whatever. The letter includes specific asks about rewording the stablecoin yield language, including striking the ability for rewards to reference account balances in any way and changing the prohibition on payments, quote, economically or functionally equivalent to yield to a prohibition on payments similarly, let's do that again. The letter includes specific asks about rewording the stablecoin yield language, including striking the ability for rewards to reference account balances in any way and changing the prohibition on payments economically or functionally equivalent to yield to a prohibition on payments substantially similar to yield. Oh my God. The letter lists numerous potential stablecoin rewards programs and banking groups say could exist under the proposed language that would violate the spirit of a potential compromise. Those payments include those include payments structured like a money market mutual fund, payments of a flat monthly reward that increases with account balance increases, and payments based on account balance but triggered by making a certain number of monthly transactions. When banks first floated concerns about the new language earlier this week, Senator Tillis replied in a statement that he and Senator Alsobrooks respectfully agree to disagree, signaling that the lawmakers were willing to proceed with a committee vote on the bill regardless. Time is of the essence for supporters of the Clarity Act, which senators on the Banking Committee have promised would be considered next week or the week following. The Senate is only in session for 2 weeks this month and will soon grind to a halt in advance of November's midterm elections. Senator Bernie Moreno, a pro-crypto member of the Senate Banking Committee, recently urged that if the bill does not pass this month, digital asset legislation will not pass for the foreseeable future. So what just happened? They had an agreement, and then the banking lobby decided, you know what? We don't have an agreement. We don't like this particular language yet again. It's overbroad. I love that terminology. It's overbroad. It's going to allow too much evasion to occur. It's going to allow too much drift from what it is that we want. And what does the banking industry want? I love this part. I'm going to read this one again. Now listen carefully to this. Banks want to add language to the legislation banning crypto companies from offering yield on stablecoins, which are cryptocurrencies pegged to the value of the US dollar. The banks say such programs could make traditional low yield savings accounts less attractive. The banks say these programs would make traditional low yield savings accounts less attractive. Right there. They don't want to boost the yield. They don't want to compete. Because it used to be that you could make a decent amount of yield on a savings account. It was 35 years ago and further away than that. It was about, I don't know, I want to say in the 80s, starting in around the 80s, you started seeing yields on savings accounts just drastically reduce. And just bled out over time to where we are now, where some people are getting like sub 1% yield on their savings account. And it was supposed to be, hey, you take your cash, that you get from your job, you walk your happy ass over to a bank, you put it in the bank, and they lend that money out, and you get a portion of whatever yield that loan was making. Essentially, they were renting your money from you. It's not terrible. I mean, I'm sure if you read the Kabbalah and the Old Testament and get really hardcore into Abrahamic law, which would include the Jews and the Muslims, because they both are, well, actually, and so is Christianity. We're all Abrahamic, but it's all from Abraham, right? But the Old Testament and the way that the Muslims work, they don't like yield. That's a bad deal. And they probably have their reasons for it that I don't want to go into. But still, it kind of makes sense. Hey, I put my money in your bank. You get to use my money, but if you use my money, I expect some rent off of that. Otherwise, just let me keep my money in the bank, don't use it, and then don't give me any yield. But that was never an option. However, over the past 30, 40 years, those yields have gone, you used to be able to get like 5%, which wasn't terrific, but it wasn't nothing to sneeze at either, especially if you had hundreds of thousands of dollars in the bank. It was actually an appreciable way to make cash. Not anymore. Not at sub 1%. Some banks I hear, I see advertisements, hey, we'll give you 1.14%. And I'm sure there's a catch to that. The banks don't want to raise. It's either they don't want to, or there's no way that they can. And I think it's that. I think that the banks have found themselves in a situation where there's no way that they can afford to increase the amount of yield on any savings or checking account at all. And that is industry-wide. It's across the board. They cannot afford it, which means they can't afford to compete with these other newer companies in the open market. And that means this is where you start getting regulatory moating, where they beg Congress. They waddle up to Congress licking their ice cream cone with a wet diaper that's full of fecal matter, and they cry and they moan and they beg. And instead of giving their customers the money for yield, they'll package somehow or another way massive campaign donations to get their way. Instead of just trying to figure out how to compete, they'll actually spend that money that they could use to compete to regulatory moat around their industry. And that's exactly what's been going on with the Clarity Act. They are unable therefore unwilling to try to compete on the open market. But there's more. Augustus gets conditional OCC approval for AI and stablecoin bank. Christina Comben is writing this one for Cointelegraph. Peter Thiel-backed payment startup Augustus received conditional approval from the United States Office of the Comptroller of the Currency to establish a U.S. national bank built around artificial intelligence and stablecoin-based payments. The approval, announced today, Monday, would allow Augustus to expand its existing European banking operations into the United States as financial firms increasingly compete to modernize cross-border settlement infrastructure using tokenized dollars and blockchain-based payment systems. The company describes Augustus National Bank as, quote, the first clearing bank for the artificial intelligence era. It's built on an AI and stablecoin native core to interact directly with machine agents at the speed of compute. And that's a quote, the speed of compute, rather than relying on batch processing and human clerks. Founded in 2022, Augustus operates under European banking licenses and says it already processes billions of dollars for institutional clients, including cryptocurrency exchange Kraken. Its proposed U.S. national bank charter, however, is still at the conditional approval stage and will only become effective once the OCC's pre-opening requirements are satisfied. While companies such as Ripple and Circle have pursued national trust bank charters under the OCC framework, only a limited number of digital asset firms have reached comparable advanced stages in the federal chartering process. The OCC approval places Augustus amongst a small group of companies that have progressed towards a national bank charter in recent years, according to the release. The move comes as competition intensifies to modernize cross-border payments and stablecoin settlement infrastructure in the U.S. Under the Guiding and Establishing Innovation for U.S. Stablecoins, or the GENIUS Act, the regime for payment stablecoins, banks and trust companies can issue fully reserved dollar tokens, and a growing group of issuers and payment companies are testing ways to integrate tokenized dollar flows into regulated banking rails. Circle's collaboration with core banking provider Finestra in August of 2025, for example, lets banks settle cross-border payments in USDC via Finestra's Global Pay Plus hub, and Citi and HSBC introduced live tokenized deposit services for 24/7 cross-border and interbank payments in November of 2025. Augustus, backed by Peter Thiel's Valar Ventures, Creandom, and the founders of companies including Ramp and Deal, have raised about $40 million, according to the company. At 25, Dabitz would be the youngest chief executive of a federally chartered bank in over 100 years. So AI payments agentically based at a bank, with that same bank being able to issue its own stablecoin pegged to the United States dollar, having banking license in the United States, as well as Europe, by the way. This would be a great way to export U.S. debt to Europe, but that's another story. I've talked about that before. This is a direct pipeline of being able to sell Europeans' United States debt. How that would work, I don't really know. What I do know is that by printing treasury bonds and selling those bonds as U.S. debt, that's sort of the way that we print a lot of money in the United States. Right now, Tether and Circle are buying a lot of, and Tether is the one that buys the most of them. It's like, at this point, Tether's like nation state level holding of U.S. Treasury bonds. But if you've got a bank that was born in Europe and now has a United States charter to operate in the United States, that to me demonstrates a pipeline, because they will be issuing their own stablecoin. It will be pegged to the US dollar. They will back that, I guarantee you, by some large percentage, double-digit percentage of treasury bonds. There's no way that doesn't get back to Europe somehow, but be that as it may. Here's the other thing about what's going on. Why the banking lobby in the first part, the first story that I just read you, why they're freaking out. They are freaking out because of shit like this. These guys are moving fast. They're moving as fast in finance at this point as the tech bros moved in technology. And the question is, how? Because the tech bros are bored with computer technology. Now their sights are set on the financial world. Before, the tech bros were contained to building iPhones and laptops and computers and operating systems and websites and whatever, man. I mean, they were basically contained in Silicon Valley, just about computers. But now the technology has infiltrated, because of Bitcoin. Technology has infiltrated finance. And most of finance is built on COBOL and 1970s and 1960s era compute languages like Fortran and COBOL and shit like Pascal and shit like that, which is ancient history at this point. But now we got Bitcoin. And God forbid the shit coins. And yeah, and God forbid stable coins as well. I'm just saying that shit's not going away. I don't embrace it. I don't like it. I wish it would all die, but it's not going to. So we're going to have to fucking deal with it. Be that as it may. These banks know what happened. They were funding. They were helping to fund the tech bros in Silicon Valley. They know how fast they work. And now they're coming after finance and markets. And the banks know they can't compete. The only thing they have left in their little bag of tricks is regulatory moating. That's it, man. But then there's the Bank of England. We're on to the third story. Bank of England chief flags coming wrestle with the United States on stablecoin oversight. Out of Decrypt, Vince D'Aquino writing, Bank of England Governor Andrew Bailey has warned of a coming wrestling match with the U.S. over stablecoin standards, claiming Friday that dollar tokens lacking direct redemption could flood Britain during a crisis. I wonder if Augustus is going to be part of that. Quote, if we want stablecoins to be a part of the architecture of payments globally, they're only going to work if we have international standards. Frankly, that, I think, is going to be a coming wrestle with the United States administration, he said. Quote, we know what would happen if there was a run on a stable coin. They'd all turn up here, Bailey added. That is an interesting statement. I'm going to have to examine that later. Bailey, who also chairs the Financial Stability Board, has long warned that dollar-pegged stablecoins could erode monetary sovereignty, pushing UK banks towards tokenized deposits over stablecoin issuance. The remarks land alongside a pushback against stablecoins from European Central Bank President Christine Lagarde, little Fifi, who argued even euro-denominated tokens would threaten financial stability and monetary policy transmission. Parallel interventions from Europe's two most powerful central banks followed Trump's Genius Act signing last July, with the FDIC and the OCC since proposing implementation rules. The Senate Banking Committee is set to mark up the Clarity Act this month. The market structure bill the White House is targeting for a July 4th passage. The FSB, Financial Stability Board's leverage does not depend on formal rulemaking authority, but on shaping a baseline international consensus that jurisdictions often converge toward as cross-border risks emerge over time, Stablecoin Standard Chairman and co-founder Christian Walker told Decrypt. Quote, stablecoins are inherently global, so long-term fragmentation between the US, UK, EU, and Asian regimes is unlikely to be sustainable, Walker said. While implementation remains uneven, the FSB's recommendations still shape how central banks, prudential regulators, and institutional participants assess credibility and systemic risks, he said. Bailey appears to overstate the convertibility risk because dollar-denominated instruments have functioned offshore for decades without direct central bank redemption lines, according to Ron Hammer, chief business officer at Orbs, who told Decrypt that, quote, Eurodollars don't have a direct redemption line to the Fed either, and the systems function just fine. Quote, if liquidity dries up on one venue, arbitrage closes the gap across the rest. The real question is reserve quality and transparency. You get that right, and the rest just sorts itself out, Hammer added. The FSB's chair was pointing to a specific risk in his warning that the U.S. framework has externalized redemption pressure to jurisdictions with stronger convertibility guarantees, Jamie Green, COO at Superset, told Decrypt. Quote, he's worried that the UK ends up absorbing the redemption risk that the U.S. framework has externalized, Green said, adding that holders in jurisdictions with stronger guarantees could become an exit route during stress events. The U.S. framework extends redemption to a 7-day window during stress, while the UK regime requires one-to-one redemption at all times via central bank deposits, noted Rohit Shablock, managing director at GRT Consulting, who told Decrypt the Genius Act is, quote, probably more innovation-friendly, requiring robust reserves, while the UK version is built for a payment system that can reliably be one-to-one at all times, end quote. Market access, not the FSB, is the real leverage, with the UK able to lock non-compliant U.S. stablecoins out of regulated payment rails, said James Brownlee, CEO of tether-backed stablecoin firm TO. Quote, that's a de facto trade barrier, and it's much harder to ignore than a set of non-binding recommendations, Brownlee told Decrypt. Cutting UK businesses off from a lower friction global payment system carries costs policymakers will be keen to avoid, he noted. There's a lot to unpack here, but I want to get back up to this one thing that I noted earlier. Bailey said, we know what would happen if there was a run on stablecoin. They'd all turn up here. I am not going to pretend like I know exactly what they mean when they're talking about a lot of the stuff that they're talking about in here, but I'm going to give you my gut feeling. They see what I see. A pipeline directly into the UK of United States debt. We're going to be able to dump on retail for the first time United States debt. Usually, the Bank of Japan would buy our bonds. The UK central bank would buy our bonds. European central bank would buy our bonds. But a lot of those guys are not buying treasury bonds very much anymore. So what could you possibly do? Oh, I know, cut out the middlemen. Because as those central banks and regular banks and whatever institutions that were not American institutions but were buying U.S. Treasury bonds, eventually that debt of the United States that we keep printing so that we're printing money eventually lands square on the shoulders of retail. But it takes time. And sometimes that can be regulated to the point that we're just not able to print as many bonds as we want because, they're taking their time offloading it to their own cattle out in the fucking field, right? So let's just cut out the middlemen altogether. We got this thing called stablecoin. You can buy it directly. You can hold it directly. And the only people that are really going to buy the bonds are the people that are issuing the stablecoins themselves. This is a pipeline. This is a way to connect the printing of United States dollars via Treasury bond issuance directly to retail for the rest of the world outside of the United States. I've been talking about the United States finding a pathway to offload debt, be able to print more dollars without it actually hitting the United States American citizen first. This is how. This is one of the mechanisms that's going to pipe our debt, basically pipe our shit right out of our house and dump it on somebody else. And it's gonna work. Don't think for a second that shit ain't gonna work. Dude. Let's run the numbers. CNBC, futures and commodities, and the Iran peace deal that was announced, 72 hours ago, is already basically just burnt up to a crisp. It's like they just poured gas on it and lit it on fire, man. How can I tell? Well, outside of news headlines, I can just look at the energy markets. Brent North Sea is up 3 1/3 to $104.68 a barrel. West Texas Intermediate also up 3 1/3 to 98 6 dimes. Natural gas not acting as a hedge. It is up 5% right now. Gasoline is up 3% to $3.63 a gallon, and Murban crude is up 3 3/4% to 102 5 dimes. Unlike normally, metals are also screaming in the green. Palladium is up 2.5 points. Gold is basically sideways, but it's still in the green. $4,733 per ounce. Platinum is up 3.8. Silver swinging for the fences, 6 3/4 point in the green, $86.03, and copper is up 2.79%. Everything in ag is green. Well, at least the agricultural futures are. Cocoa, chocolate, dude, double digit, 12.8% to the upside. Coffee, or rather, let's see, I don't have any losers at all. So the one that's made the least amount of gain is rough rice. It's 1/3 of a point to the upside. Cattle, however, different story. A small row of sticks to the downside, 0.11% off. Lean hogs, however, up 1 1/4. Feeder cattle are down just over a point. S&P is up 1/3 of a point. NASDAQ is up almost a half. The Dow is essentially flat, and the S&P Mini losing 0.14%. And then we're at Bitcoin at $81,870 after wild swings between last night, for me, Sunday night, and this morning. I mean, wild swings. It looks like somebody was trying to wipe out the shorts and then wipe out all the longs and then wipe out the shorts again. And it looks like they may be going after the longs again. I don't know. I don't know what's going on. It makes me very, very confused. However, it's still a $1.64 trillion market cap. We can purchase 17.4 ounces of our favorite shiny metal rock with our one Bitcoin, of which there are 20,027,782.4 of. Fees are low, 0.01 BTC, taken in fees on a per block basis. There's 35. No, I take that back. There's about 40 blocks carrying 110,000 unconfirmed transactions waiting to clear at high priority rates of 3 sats per VByte. Low priorities get you in at 0.8. Woohoo! 1.01 zettahashes per second. Ladies and gentlemen, congratulations. We've made it back to the zettahash scale. It's all the hash rate on the Bitcoin network that provides the security for the network, and I'm fine with it at half that rate, honestly. From Lagarde on Guard, which was Friday's episode of Bitcoin, and Mondo Arg, or ARG, with 5,000 sats, brother, says crass commercial message. Follow me on Deadbird at Mondo ARG. Thank you, sir. No, thank you. Again, go find him on Deadbird. Mondo ARG. That's Mondo ARG, MONDOARG with the @ in front. Nick Dose 209 says, cheers. Right back at you, pal. Noster Gang with 121 sats says, thank you, no thank you, and that's the weather report. Welcome to part 2 of the news that you can use. Let's tackle this Australia business. Brian Quarmby out of Cointelegraph writes, Australia plans capital gains tax changes affecting crypto investors. The Australian government is reportedly seeking to replace capital gains tax discounts on crypto and other assets with an inflation indexation tax. Never even heard of that, which could increase the taxes on long-term crypto gains. The Albanese government's fiscal year 2027 budget, set to be released on Tuesday, would cut the current 50% capital gains tax discount alongside changes to housing investment taxes, the Australian Financial Review reported on Sunday. Australian investors can currently claim a 50% capital gains tax discount on assets held for longer than a year. The proposed indexation model would instead tax full real gains adjusted for inflation, over the time the asset is held. I gotta pause. I gotta talk about it right freaking now. So inflation is a hidden tax on the people. If you don't know that, you should. It is a well-known feature of what inflation actually is. Instead of just saying, hey, you were able to buy a loaf of bread for $1 100 years ago. Here it is today, 100 years later, and that same size loaf of bread cost you exactly $1. That is 100 years of zero inflation. But you pay us every year 10% of your paycheck. Okay, that's just straight up theft. But that's not reality. Here's the reality of the world, ladies and gentlemen. 100 years ago, I could buy a loaf of bread for, let's say, $1. I am buying a smaller loaf of bread 100 years later for $5 a loaf. And I'm paying 10% taxes on my income. So there's still outright theft right in your face, taking my money for shit you don't deserve it. You don't get to just have my money unless you threaten me with jail or point a gun in my face and all that kind of shit. It's violence. It's theft at the end of the gun. I'm sorry, but that's what it is. It's not, but what about the roads? What about this? What about, yeah, well, if they would actually spend the money properly without screwing everything up, I might actually be okay with it, but that hasn't been the case in, forever because of corruption and other items. But be that as it may, it's the $1 I used to pay for a loaf of bread 100 years ago versus the $5 I now pay for a smaller loaf of bread. That's another kind of tax. That's inflation. And now they're plugging that into capital gains. It's almost as if it's like a 1-2 punch, except both together. First, you get punched in the face because they're taking your money straight out of your paycheck and telling you, if you don't do it, we're going to put you in jail. The second punch is inflation. But now they want to punch you with both fists in the face at the exact same time by hooking these two things together. This is sick. It is sick that they would even think about this. The move is likely to impact long-term investors. They could potentially see a significant increase in tax obligations for high-income earners on assets with low inflation-adjusted returns. Chris Joy, a portfolio manager at Coolabah Capital Investments and an AFR columnist, criticized the change, arguing in an ex-post that it would drive Australians out of most forms of investments and into assets with tax incentives such as housing, which means housing prices, which are already through the roof in Australia, are going to get fucking worse. Quote, after the budget doubles, The capital gains tax on productive businesses and assets from about 23.5% to somewhere between 46 to 47%. Investors will understandably pull money from businesses, shares, commercial property, and rental housing and plowing it into their tax-free owner-occupied home. Quote, the single biggest winner from the budget, the tax-free owner-occupied home, which is where people will put their money, Joy said. Changes in the federal budget will take effect at the end of the fiscal year, July 2027, with a one-year grace period for assets acquired after May 10th. During the transition to a new system, the existing 50% discount will still apply. The AFR report also notes that assets purchased on or before May the 10th will be partially exempt, with the final capital gains tax discount calculated proportionally based on how long the asset was held under each tax regime. Scott Phillips, chief investment officer at investment advice firm The Motley Fool, argued that while investors will likely pay more tax under the changes, they will still make considerable returns and be incentivized for further investments. Quote, not for nothing, but when people say a CGT change would hit founders and growth investors, they're not wrong. But implicit in that argument is that those groups will be making a matzah in the first place. That's all the incentive that they will need, he said. That's the end of the article. I haven't listened to Motley Fool in years because about 15 years ago, I saw a real change in how they started to cheerlead basically for policies and things that, well, I just don't think that they're good. This is somebody who's basically saying, oh no, this is going to be fine. It's not going to be fine. Sure, the founders and the growth investors, they may keep their money in, but what's going to happen regardless is that enough won't, and they are going to plow their money into housing and anything else that is has a tax-free incentive. Which, and I don't know this because I don't live in Australia, but if houses are tax-free incentivized, then there's probably a lot of other stuff that, generally speaking, most people need on a daily basis. And those are going to be bought too. And what's going to happen to those prices? They're going to go through the roof again. This shit is already out of reach. You're going to start seeing riots, man. I am absolutely dumbfounded at this point that we do not see riots and demonstrations that haven't turned violent. And I'm talking seriously violent. Seriously violent to me means storming of Parliament, the dragging out of anybody even remotely related to the government into the street and beaten either to death or to within inches of their lives. I don't want to see it happen. What I'm saying is that I can't believe that I haven't seen it happen. How much if you've listened to this show for any length of time, I've said it many times. The human species can take a lot of shit. I think we're past what I always thought was the level of shit that humans could take before they just go, I got nothing left. I got no patience left. I have no hope left. I have almost no money left. I have no future left. I got nothing to fucking lose. I'm done with these people, and I'm physically going to do something about it, and we haven't seen it yet. Yes, we've seen violent demonstrations in the past. Yes, they're getting more and more frequent. But not at a countrywide scale of something like a Western European or just Western country, something as big as Australia, something as big as the United Kingdom, something as big as France or Spain. At one point or another, it's going to happen. and you don't want to have anything to do with it. You want to be as far away from a big city, especially a capital city, where government officials are. You don't want to have anything to do within 100 miles of that thing. That is great. In the next 25 years, that is going to be ground zero for probably some of the most violent shit you've ever seen in your entire life. Do yourself a favor, get as far away from it as possible. And that goes like in the United States, state capitals. Probably going to be a little bit safer. We'll see. But meanwhile, it's whale watching time. Bitcoin whale address moves $41 million in Bitcoin after a 12-year dormancy. Danny Park from The Block. And before I read it, which is very short, I just want to say why I'm reading it, because we get whale reports all the time and I don't normally actually read them. But I'm starting to see this more and more. Starting to see a pattern. I've kind of noticed a pattern for a while, but if I haven't said it on the show, I want to make sure that I say it on the show today. A Bitcoin whale address moved $40.6 million worth of Bitcoin to a new address after 12 years of inactivity. According to Arkham's on-chain data, the whale moved 500 Bitcoin from address number 1 to address number 2 at around 3:16 p.m. Sunday Eastern Time. The Bitcoin had been sitting in the former address since November 27th, 2013. When the owner first received the Bitcoin, 500 Bitcoin was worth roughly $457,000, indicating that its value has appreciated about 89x over the past 12 years. While the reason behind the move is unclear, such transfers typically precede token sales for the owner to cash out profits. There have been several occasions where such large holders woke up after over a decade to move their crypto. Last month, an Ethereum ICO participant moved $23 million in ETH to a new wallet address after staying dormant since July of 2015. Bitcoin's price rose notably in recent weeks to trade around $81,000 to $82,000, and then they do more price action. Okay, so there's the deal. And there's a couple of key parts of this. First, and this is I want to analyze how these like reports of whale movement occur. First, we get a report of how much it is. Second, we get a report in the second part of the report, we get how long it's been sitting there. So in this case, about $41 million sitting dormant for 12 years. Then we get the notion that it went just to another Bitcoin address. Not a Coinbase address. It's just another address. And we don't know if it's an exchange address, a Kraken address, a Coinbase address. We don't know. It's just another address. And then we get the timestamp. And we get the day. And we get, how much it rose up in value. But there's, and then that's right. I like when it says this. The reason behind the move is unclear, but such transfers typically precede selling so the owner can cash out profits. Now, look at when this happened. 3:16 p.m. Sunday Eastern Time. If I go back and I look at the chart at around that time on an hourly chart for Bitcoin, I see a massive red spike to the day. Well, a red spike. It's price going down. And it was massive, right? But we don't know if anybody sold anything, and we kind of can't know. I think every time that red spike, that red candle, it was preceded by a very large gain in momentum to the positive side for Bitcoin price. It was almost as if, nope, can't have that. So here's what I'll do. I will move a shit ton of Bitcoin from one address to another address and let's say, I'm just going to make this assumption. I have no intention of selling it. It's going to be picked up by Arkham Intelligence. And Arkham Intelligence is going to say something to somebody saying, hey, we got whale movement. And somebody like The Block is going to write a story about it without any knowledge whatsoever as to intent. Because honestly, this goes from a 1KAA address. That's the preceding 4 digits of that address is 1KAA. That is a very, very, very old address type. And it moved to a BC1 type, which is a much newer kind of address for Bitcoin. It wasn't available back when this guy got his first Bitcoin. There was no BC1 around that time, or at least I don't think there was. In either event, all that's happened is that 500 Bitcoin has moved from one wallet address to another wallet address. It got picked up in the news wires, and it was immediately broadcast. And yes, I'm not helping the situation by telling you about this either. However, I think this activity is done on purpose by whales to suppress price, to spread fear into the markets. And maybe who knows, maybe they want to see if they can wash out longs that are going, oh, holy shit, the Bitcoin price is rising. And I think it's going to be like 10% higher. So I'm going to go long Bitcoin at that price. And then all of a sudden a whale moves in and all he does is move Bitcoin, 500 of it from one address to another. And that long gets wiped out, gone. That's what this whale movement that's mostly what I see. Because you know what we're never going to hear about this news story? Well, did he sell it? You're never going to know. You're never going to know. It is to inspire fear in the market. And there's enough of these dickheads out there that they can inspire a lot of fear. And that brings me to another point. I'm not sure how these people can consider themselves true Bitcoiners only because they own a shit ton of Bitcoin. When you make motions like this to affect and inject fear into the wider populace, you're not a good person. You're just not. Even if you're doing it so that you can wipe out a long because you took a short, and longs pay the shorts on that kind of situation, and you're just looking for more money, you're fucking it up for everybody else. You're screwing other people out of their Bitcoin because they get scared and they sell. Oh my God, a whale's moved his Bitcoin. They're going to sell. So I got to sell mine first. And what happened? The prices come back up to almost $82,000. Please do not get stuck in this trap. That's all this shit is. It's a trap. When you see a whale movement, the first thing that you should be thinking is trap. Just saying. Because a lot of people captured this loose Bitcoin. And one of them is Bitcoin funds. They captured $700 million as institutions are placing their bets. This is Omkar Godboll out of CoinDesk. Institutional demand for crypto is real and suggests that there may be a sustained Bitcoin price move above its pivotal 200-day simple moving average. Investors poured $858 million into crypto funds issued by asset managers like BlackRock and 21 Shares last week. Okay, $858 million just last week. That extended a 5-week inflow streak and marking the strongest weekly total since late April, according to CoinShares. More importantly, Bitcoin funds alone pulled in over 700 million of that 858 million, taking year-to-date flows to $4.9 billion year-to-date. So this time last year, almost $5 billion have flowed into Bitcoin. Talk about the demand for the leading cryptocurrency. The catalyst? Improving sentiment around the Clarity Act, according to CoinShares head of research, James Butterfield. Bitcoin recently traded at 81,000. Yes, we know we got price action, yada, yada, yada. Analysts say the next big move, blah, 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 blah. See, is there anything other than price action? Nope. They're just going to talk about shit coins and its price action at that point. So the news here is that $700 million in Bitcoin have been bought by Bitcoin ETFs last week. And people like the whale swimming around making waves cause people to sell their Bitcoin. And when a bunch of Bitcoin's floating around on the open market, these ETFs are going to buy them. They're going to buy them. Don't sell your Bitcoin to Sailor or BlackRock or 21 Shares, please. All right, last up today, Morgan Stanley's Bitcoin F ETF absorbs $194 million in its first month with no net daily outflow. Zach Abrams is going to talk about just the brand new Morgan Stanley Bitcoin F ETF. It's the newest kid on the block. They are like 2 years late getting their product to market, and it's done very well. In fact, it's done very, very well. The Morgan Stanley Bitcoin Trust has completed its first month on the market without recording a single day of net redemptions, a streak that no rival spot Bitcoin fund matched over the same window. MSBT launched April the 8th with what Morgan Stanley's head of digital asset strategy, Amy Oldenburg, called the bank's strongest ever ETF debut, logging $30.6 million in net inflows and roughly $34 million in trading volume on day one. Bloomberg senior ETF analyst Eric Balchunas placed the debut in the top 1% of all ETF launches. That strong open came on a day when the broader spot Bitcoin ETF market posted $94 million in net outflows. So value data reviewed by the block shows daily inflows tapering from high teens millions in MSBT's first 2 weeks to single digit millions in later sessions, but never dipping below zero. Over the same window, the total spot Bitcoin ETF market swung between 663.9 million inflow day on April the 17th and back-to-back outflows of 277 million and 145 million on May the 7th and May the 8th. On May the 7th, MSBT posted 5.7 million in inflows, while BlackRock's IBIT recorded a negative $27.2 million loss. Fidelity's FBTC, they logged a $97.6 million outflow, and ARCB posted minus $26.6 million outflow. MSBT was trading at a 0.24% premium to NAV, higher than IBIT's 0.18% and FBTC's 0.13%, suggesting demand was outpacing creation unit supply. Within 6 trading days of launch, MSBT had crossed $103 million in total net inflows, surpassing the $86 million all-time cumulative total of Wisdom Tree's BTCW, a fund that's been trading since 2024. MSBT's 0.14% annual sponsor fee is the lowest among all U.S. spot Bitcoin ETFs. It undercuts the Grayscale Bitcoin Mini Trust at 0.15%, Bitwise's at 0.2%, ARCB at 0.21%, and both IBIT and FBTC at 0.25%. Grayscale's original GBTC still charges 1.5%. Wow. Talk about irrelevant, dude. Holy shit. Get it together, Grayscale. Whether the fee discount is driving MSBT's stickiness is unclear. The 11 basis point gap between MSBT and IBIT is negligible on a retail position, but at institutional scale, it amounts to $1.1 million annually per $1 billion invested. The Grayscale Bitcoin Mini Trust, MSBT's closest fee competitor at 0.15%, saw a choppier flow profile over the same window, recording at least one outflow day and generally smaller daily inflows despite holding $4.3 billion in net assets. Nearly all of MSBT's first month inflows came from self-directed clients. That's per the company. Morgan Stanley operates roughly 16,000 financial advisors. It manages $9.3 trillion in client assets, but the fund was not available on the bank's advisory wealth management platform during its first weeks. Quote, almost all of that first week or two of activity was self-directed, meaning it was not our advisors that were selling this, Amy Oldenburg, Morgan Stanley's head of digital assets, said at the Consensus Conference in Miami. Once that channel fully opens, MSBT would gain a proprietary distribution pipeline that no other Bitcoin ETF issuer can match. The bank is also piloting spot crypto trading on E-Trade with a 50 basis point transaction fee, starting with Bitcoin and a couple of shitcoins. MSBT's first month coincided with a broader recovery in spot Bitcoin ETF demand. And then they talk about the same numbers that we just talked about with the story that I just read you before this one. Dude, that's the biggest news about this is not just that that this particular fund, the Morgan Stanley Bitcoin ETF, it's not just that they basically beat the living snot out of all the rest of the ETF's first month performance. But for the first half of that month, it was just regular retail clients buying Bitcoin. Yeah, I know. I get it. There's going to be some people in there that you would not consider quote unquote retail, like Bob the bricklayer, right? It'd be like larger people with Morgan Stanley accounts, but they're doing it themselves. They're not calling up their broker because their broker couldn't do it for them. Their financial advisor from Morgan Stanley was unable to execute that trade themselves. So the client had to do it. That's what Amy Oldenburg is saying. The client themselves was so interested in buying this product that they went through the friction of getting into their Morgan Stanley account on their computer, getting some money over there in cash, and actually executing the trade to buy that product. They did not just call up Mike, the financial advisor, and say, hey, Mike, buy this shit for me, and here's the parameters of the buy. That couldn't happen. So not only did Morgan Stanley's Bitcoin ETF basically beat everybody else, not only did their clients actually self-direct themselves to buy this product and go through the friction to do that, but this product is 2 years old in comparison to at least 11 Bitcoin ETFs that all opened up trading within 24 hours of each other like 2 years ago. There's a lot to that story. And we, just a reminder, 16,000 financial advisors. Hold on. I want to do something here for a second. Okay, so I wanted to make sure what it was that I was talking about when it came to numbers and the United States Army. Like the United States Army, not the Marines, not the Navy, not the Air Force, just the United States Army has a couple of armies, right? There's the First Army. An army is in World War II, the First Army was 520,000 people. Do the math. 16,000 financial advisors. It's not exactly an army, but it's not exactly something to sneeze at either. And they were essentially offline for the first 2 weeks of this product launch. After this product launch, there were 16,000 financial advisors that couldn't do dick. They couldn't. It's not that they wouldn't, it's that they didn't have the functionality sitting at their desk to be able to execute this shit. The clients did it themselves. And now they can. So you got 16,000 financial advisors Maybe I don't know what that actually ends up being. Let me find out. Okay, I've got it now. So a full army, like the United States First Army, is about 500,000 soldiers. A field army is 100,000 soldiers. A corps is 20 to 45,000 soldiers. Where we're at is 16,000 financial soldiers. That's a division. That is like 1,000 people more than the max number of a full division for the U.S. Army. I cannot stress this enough. This is what BlackRock does not have. They never needed it before because they were basically not exactly retail. A lot of these people weren't. Fidelity, yeah, they're going to have that kind of shit, but not to the extreme that Morgan Stanley has. I've read at least 4 stories that try to impress upon people just how many more financial advisors Morgan Stanley has than everybody else. And I want to make sure that we understand what we're talking about here. 16,000 financial advisors is a lot of freaking people, right? I know it sounds like I'm rah-rahing Bitcoin ETFs. I do not suggest buying them. In fact, my recommendation is stay away from them. Just don't. Just because you can buy your own Bitcoin, and you need to do it now while we have the least amount of friction to be able to buy Bitcoin and hold it yourself. Because especially if you're living in freaking Europe or the UK or God forbid South Africa, because they want to make self-possession of Bitcoin completely illegal. Australia and New Zealand, they're probably not far behind, right? China, really? Do I need to explain myself here? You need to buy the Bitcoin while you can. Gather ye rosebuds while ye may, motherfucker, because there may be a day that comes when you can't. Or at least where there's a lot more friction than there is right now. The best time to buy Bitcoin was 10 years ago, 12 years ago, right? Maybe 17 years ago, when like on January the 3rd, figuring out a way to get some. It was the best time to acquire Bitcoin. The next best time is today, because we do not know what tomorrow will bring, except for one thing. I will see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.